Now, I often find that people that are keen to invest in individual shares get stuck on the amount of research that they may need to do, or they get stuck on where they should even go. And then when they've figured out those two things, they then figure out, well, how do we actually go through a checklist to determine which shares we should buy and at what price? That's what we're talking about today. So, hope you get some value to that. Make sure that you like and subscribe to this channel for more content of a general nature like this. Let's get started. Tom Bodica, how are you?
I'm doing very well, Darcy. It's been a while since we've caught up, so this should be fun.
Heck yeah. And so the reason why I've got you on is because I want to have a general chat around investing in individual shares, specifically using the value investing paradigm. So we'll get into that a little bit, and maybe we can talk about your own checklist that you follow, Tom. Is that okay?
Yeah, sure.
But firstly, I want to know, because when I was doing a little bit of research for this, I discovered some rather old videos on YouTube from you, and you weren't talking about investing, you were talking about deadlifting. So let's start off
Oh,
here.
wow, you found those.
I
Okay.
found those, huh? It's amazing what you can find when you put your shields up on Brave browser. But tell me a little bit about, what do you say is the common thread between deadlifting and investing?
I have always been a bit of a maths nerd, actually. So I enjoy sports and, I guess investing kind of ties in a little bit there where you can put numbers on them. So I always enjoyed sort of the progression in powerlifting where you could work really hard, train a bunch, eat lots of food, and steadily put more and more weight on the bar and compete against other people. So,
Yeah.
I competed in powerlifting for probably 4 years. I made
Wow.
the New Zealand under 23 team at one stage a few years back. Got to compete at the Asia Oceania Champs over in Singapore, which was quite cool. But just got a little bit tired of the repetitive nature of powerlifting training, I think, a little bit. So don't do a huge amount of it anymore. But
Yeah.
that kept me pretty busy outside of work for several years, actually.
There would have been a routine that you would have followed to get the result
For
that you
sure.
wanted at the end of it, right? And I guess, is that kind of what you take out of that and apply it into the investment bit in terms of the discipline part?
Yeah, I think it can be applied to all sorts of aspects of life, to be honest. I mean, powerlifting, in the early days, like it's the type of thing where you can basically look at some weights and get stronger. And
Right.
as you progress, it gets more and more challenging, and you got to work harder and harder. And it was like in the first few years, you could put 20 or 30 kilos on your deadlift or something each year. And then once you're a little more advanced, if you put on 2.5 or 5 kilos to your personal best deadlift in a year, that was kind of a good 12 months. And yeah, it required increasing amounts of discipline and that sort of thing as years went by. So bringing that across to like my professional life, to the YouTube channel, and just putting out content, consistently, it's been a huge help, actually. Yeah.
Yeah. No, that's cool. And that's kind of how I think I first came across you, was the YouTube channel. And it's been like phenomenal education from my perspective, just understanding at a really, I guess it's like a microcosm. In investing, you have these silos, and
Yeah.
some would look at that and go, well, there shouldn't be silos. It should all just be one happy community. And it is kind of at a level, it's kind of like that. But when you get into these silos and then you get really deep into the weeds around each one of these disciplines, I guess you'd call it, and value investing is kind of like a discipline or a mindset, isn't it? You discover that there is a science, there is structure, and there is a methodology. So you really helped me to understand that a little bit with your YouTube channel. But just tell me a little bit about the journey around that, like why you started to do the videos on YouTube and how that kind of progressed.
Yeah, sure. Well, I'm glad to hear the videos have been somewhat helpful. I actually got a
Yeah,
notification from YouTube that I've had the YouTube channel 4 years exactly today, so that was a nice little milestone. But
congratulations.
yeah, thanks for that. I basically started the YouTube channel because I was getting really interested in this stuff personally, and no one else wanted to talk to me about it, basically. So you'll know this all too well, Darcy. It's like whenever you talk about investing with people in New Zealand, everyone sort of immediately just defaults to real estate, is what I found. Maybe that's changing a little bit in the past couple of years, but certainly, back in 2017, 2018, that's what it was like for me. I work and grew up in like the agricultural space. So farm ownership was like a big thing in that world as an investment, but you're talking like millions of dollars. And here I am, a few months out of university sort of thing, definitely not being able to do that. So
Mhm.
I stumbled on stock market or share market, eventually came across Warren Buffett and the world of value investing, and kind of went down the rabbit hole and kind of yeah, started putting ideas out there on YouTube, built up a bit of a community. And I think there's also a lot of advantages just to, as again, I'm sure you've found, to trying to learn in public, I guess. And whenever you turn a camera on or a microphone on and record yourself talking about investment ideas or any sort of ideas, you pretty quickly figure out whether you actually understand it or not when you try to explain it to a camera. So it's been
Mm.
quite beneficial from that aspect as well.
Yeah, and I guess maybe that is another similarity with deadlifting, right? Like that is like the ultimate test. All the training, all the research, all the reading. You turn on the camera,
Yep.
and if you don't know what you're talking about, or I guess it's not so much about not knowing what you're talking about, but if you're not prepared to learn while you're trying to explain, then it gets a bit awkward, doesn't it?
Yeah, for sure. It's like I can't really think of a good example, but it's one of those things like if you ask someone if they understand a particular concept or something, often people will say yes, or if you ask them to rate it 1 to 10 or something, yeah, they might put out a 6 or a 7 or something, that in terms of their level of understanding about a particular subject. But when you kind of turn the tables on them and say, okay, well, explain it to me, you pretty quickly find out whether they actually understand it or something. It's a lot like that to me.
And what is like the overall motivation? Why do you invest, Tom?
Sure. I think I probably have a pretty similar answer to pretty much anyone that's probably listening to this podcast, which is, the eventual goal is to get towards financial freedom. And like you mentioned, there's all sorts of different pockets of the investment community and personal finance community that maybe have slightly different views on the best way to get there. But um, yeah, value investing is something I found myself really comfortable with over time. But the end goal is financial freedom and being able to not necessarily work because I have to, but work because I want. Just kind of have more choices. I have no aspirations to own 10 Ferraris or anything like that.
Right. Well, you're not into crypto, so that's not even possible, Tom. Let's be honest, right?
Yeah, I guess not. Yeah, so no aspirations to own a bunch of supercars. I just want to have more choices, basically. A nice boat, maybe, but
A nice
yeah,
fishing boat, right?
yeah. There you go.
Yeah, that's awesome. So I'm just going to read out this definition of value investing for those in my audience who don't necessarily have the same sort of understanding as what your audience might have, Tom. Value investing is a strategy that involves buying stocks that appear underpriced relative to their intrinsic value. So I want to unlock two of those words with you, Tom. The first one is underpriced. What does it mean if a stock in a particular company is underpriced?
Yeah, sure. I guess what we're basically trying to do when we invest in anything, and I mean, value investing is commonly applied to the stock market, but it could be a piece of real estate or a private business or a bond or anything that produces cash flow. Basically, we're trying to understand what we think that particular asset is worth based off the cash that it's likely to generate over time, and if we can buy those assets for a price lower than what we think it's worth, that does a couple of really cool things. It offers us some downside protection or margin of safety in value investing language. Should the cash flows not turn up as to the degree that we maybe expected, and it also potentially provides some more upside as well if you get sort of a re-rate and the market value of that asset up closer to what you view as its underlying intrinsic value. That can do good things for your returns as well. So
Okay.
that's
So
what
we're
that
trying to
means.
get it at a discount, so to speak, so that if things go really bad in the market or with that company, it's okay. You're already starting out ahead. And if things normalize to the average level, well, we know that over the long term, it's going to reach that average. So if it's below average, then more likely we're going to get a gain there, right?
Exactly. I mean, to give you an example, I've got an investment in a real estate investment trust that's listed in the States at the moment, and they own basically all of the real estate that used to be the old Sears stores before
Oh,
Sears
yeah.
went bankrupt. And
Yeah.
essentially, if you just go through, and it's actually quite a time-consuming exercise, speaking from experience, but if you go through and basically just try and get a market valuation on what could you sell of each of these properties for at the time I first got invested, there was 170 of them, I think. If you just go through that process, try and understand what the you know basically liquidation value of that company would be, if you sold all the real estate, paid off all the debt, and distributed the cash to shareholders, what would the dollars per share and distributions kind of be? And when I went through that exercise, it was in like the $25 per share range, and the market price was like $10 or $12 per share, for example. So that's the type of opportunity I'm trying to find. Basically, that's what
Sure.
I would define as like a margin of safety.
Got it. And that also speaks to that word intrinsic, or that phrase intrinsic value. So intrinsic value, can you just define that, flesh that out a little bit more as well?
It's basically what something is worth. I guess the classic definition is like I think his name's John Burr Williams, who kind of came up with the idea of a discounted cash flow initially. So if you were all knowing about the future and you could look at a particular cash producing asset, usually a company, and you could come to an accurate assessment, of all the cash that that company would ever distribute between now and Judgment Day, as Warren Buffett always often phrases it, and you discount those cash flows back at some sort of appropriate interest rate, the sum of all those kind of discounted cash flows would be intrinsic value. That's kind of the classical definition. There's other ways of approaching it. Like I just gave an example earlier of like a very hard asset liquidation value type approach. So there's a few ways to tackle it, but yeah, essentially you're just trying to come up with what something's worth based off the fundamentals of either the cash it produces or the assets that it owns.
Okay. When you're selecting your group of stocks that you want to target, obviously there's a season where you're going to be researching and waiting for the stock price to fall below the intrinsic value to a point where you've got that margin of safety where you then execute on that purchase. Going right back to the start, how do you actually create a short list of the companies that you're researching and that you might inevitably buy into?
Yeah, sure. It actually happens in kind of randomly to a certain extent. In some cases, there's companies that I just naturally understand pretty well because I'm a consumer of them, like like a Apple or McDonald's or Domino's Pizza or Microsoft or something like that. Companies that we're all pretty familiar with. With a little bit of groundwork, we could probably understand them pretty well. And most of those companies are relatively stable, steadily kind of growing businesses. So those are the types of companies that I would tend to check in on every so often, put some sort of valuation on them, and often they're not trading at huge margins of safety because everyone kind of knows they're good businesses. So that's kind of one basket. The other basket is I just kind of randomly see things pop up in some of the communities I'm involved in. In the US, we have, they have 13F filings, which are literally quarterly filings that show us what our favorite investors have been buying and selling. So that's a really nice way of sourcing ideas. If it has the Warren Buffett tick of approval where he's just sunk like $10 billion into it, that's probably not a bad place to start looking. And then, I see things on Twitter from other investors that I really have a lot of respect for, or YouTube kind of content that I follow and that type of thing. So it can come from all sorts of places. The Value Investors Club is a really nice forum where people post quite detailed investment write-ups. So can kind of come from anywhere, but I do have like a bit of a short list of some of those higher quality companies that I'm always keeping a general eye on.
Right. So you take the short list of these high quality companies that you're keeping an eye on. Do you put it into, or do you use any software platform or any service to actually do the analysis? Like, how do you pull the data out and then start going through it?
Yeah, often I just go directly to the source. Like I'll simply just go to, well, there are tools that I use, basic stuff like Yahoo Finance or Simply Wall Street or Ticker is another one that I use just to look at some basic financial data for the company. Have they been growing over the past few years? What are some basic kind of price multiples in terms of the current valuation for the company? So I do actually look at some of those things initially. Then if something kind of piques my interest, I really just go to the source data. So I go to, most companies have an investor relations page where you can see quarterly presentations, annual reports, maybe some longer term business plans. A lot of US companies have, quarterly conference calls and that type of thing. So I don't know. I'll just be walking down yesterday I was walking down the street because we ran out of milk. So at lunchtime, I went for a walk to go get some milk, and I listened to the Ally Financial quarterly conference call that came out last week. So I'm a nerd like that, but that's kind of how I tend to get get information in my head anyway. So
That's cool.
yeah.
Were you like that before, Tom, or was it the whole practice of this? Has it really ignited something in you that you didn't know was already there? Or were you always kind of like really interested in the fundamentals of how businesses operated?
I think it's definitely picked up over time. Probably as I've just grown to appreciate like how rare really high quality businesses are, and how tough it can be to like find those businesses at reasonable prices. I think I've just grown to appreciate kind of the treasure hunt aspect of it.
Yeah,
So
yeah,
um, yeah,
yeah.
I definitely didn't used to be like that. I've always wanted to find a path to building wealth that kind of fits my personality, and I guess I've just gone towards this method
Cool.
over time.
It's like you're the sort of slightly shady looking character driving the van. You're kind of just waiting for conditions to almost deliver an underpriced company to you, aren't you? Like you're literally
Yeah.
stalking these companies in a really seedy sort of way, in a good way, of course. And then it's like steady as she goes, but when the seas get rough, that delivers you the opportunity, right?
Yeah, yeah, for sure. I mean, I don't know. I don't know if it's just been a few years now of just kind of thinking about businesses all the time. But I walk through the airport or something, and I see these airport scanners people walk through, and I wonder, oh, are they a public company? That seems like a monopoly kind of business. There can't be a lot of competitors in that space. So I just have all these thoughts going through my head at all times. And it's
Yeah,
quite cool when you find one of those companies that's actually public, and you can do some digging into how they actually been performing and that type of
got
stuff.
it. And so you kind of naturally, normally aware, you're always curious, inquisitive, you're doing research, you then formulate a short list of companies. Maybe you use some platforms like Simply Wall Street, or you go to the investor relations page, but you're slowly kind of immersing yourself in these businesses, trying to do what? Are you trying to work out what like if you do decide, yes, I would like to own this company, presumably there's a checklist of sorts, and that's kind of what I'd really like to get stuck into. Is that kind of what the next stage would be? Once you've got a short list of companies, you run them through a bit of a spreadsheet or a checklist of sorts?
Yeah, I definitely have a checklist. I guess the final point I'm really trying to get to is a confident kind of valuation of a company. And if it's not a company that has a bunch of hard assets, like some sort of relatively quick growing software company, for example, is not going to have a lot of hard assets. You're going to be valuing that mainly on the cash flows that they produce. So the end point I'm really trying to get to is a valuation on the company. You won't be able to value every company because there'll be a bunch of companies that you won't necessarily understand well enough to have confidence in a valuation. So
Yeah.
that's, I guess, the end point I'm trying to get to. And there's a lot of kind of filters and checklist items I work through to get to that point. So I do have a checklist. It follows like Phil Town as an investor. I
Mm,
followed pretty early in like the value investing kind of days. And I use
yeah.
his basic framework. So he has this 4M checklist of meaning. Do you understand the business? Moat. Does it have some sort of competitive advantage? Management. Does the CEO and board of directors and so on have integrity and talent? And then the fourth M is margin of safety. So that's the general process I work through.
Okay. Just to
Yeah.
clarify, Phil Town, he's the one that does a really good podcast. I think it's Rule One podcast with his daughter. Is that right?
Yeah. So his brand is Real One Investing, and it's the Invested podcast, I believe. Yeah.
Right.
So with his
Definitely
daughter,
worth.
Danielle. Yeah.
Yeah, definitely worth checking out.
Yeah.
But take us through the first one. So the first one is meaning. So unpack that a little bit for me, Tom.
Yeah, sure. So this can be quite a big one. It's basically, do you understand the mechanics of how this business works? So the business model of Apple for most people is going to be a pretty straightforward one to understand. They produce some revenue from selling, or a lot of revenue from selling devices, whether it's iPhones, iPads, Mac computers, maybe accessories, that type of thing. So getting your head around that kind of revenue breakdown, how profitable are each of those segments, and where do you think those segments are going in future? That's really the type of stuff I'm trying to understand. Um, if I was to try and go through that exercise for some sort of giant pharmaceutical company that has all these drug patents that I don't understand the use case for because I'm not a doctor or anything,
Sure.
that would fail a lot of those tests. So that's just really what I'm trying to get my head around. If a
Right.
company were to come out and report their latest numbers. If I understand that business well, there'll be key areas that I know I want to kind of dive into, and I can
Right.
kind of look at the figures and understand whether they're actually performing well or not. And that's
Right.
much easier in my case, at least, for something like Apple than a pharmaceutical company. But for different people, that may vary. Maybe you work in pharmaceuticals or something, and you understand that really well. You could have an edge there. But
Going back to the airport scanners that you mentioned, if you were trying to test whether or not you understood the meaning of a business, what are some of the questions that you would pose to yourself to test your understanding?
yeah, sure. So it would be stuff like, can I lay out the key metrics that I would want to focus on if I was like running the business, the key KPIs? If it's a commodity business, it might be focusing on things like the cost per unit of production, for example. So that's the type of stuff I'm usually getting at. And a lot of it is about trying to make some sort of prediction about the future, because that's the stock market really is a discounting machine. It's looking at what's the likely future cash flows from this big basket of businesses. And if I don't think I can come to a reasonable estimate of that, then it kind of fails that meaning test. So if I can't come to a view on whether I think Apple is going to be bigger in 5 or 10 years than it is today, then I'm probably not going to look to invest in Apple. And if I can't
I see.
figure out whether a pharmaceutical company that I'm looking at is going to be bigger in 5 or 10 years than it is today, then I'm not going to look at it. So that's the type of point I'm trying to get to.
Got it. And it doesn't necessarily take options off the table. It just means that while there might be great opportunities everywhere in the share market, you're only going to focus necessarily on the ones that you can get some understanding on, where you can get some understanding on the meaning, right?
Yeah, I mean, the last thing you want to do is invest in some company you don't understand, and then the stock price goes down 50% while you own the shares, and you have no idea what you should do about it.
Yeah.
That's not a position you want to get into. So that's really what
Yeah.
understanding the business is all about. If you do go through that experience, you buy into a company, the share price goes down. You feel that you have a pretty good understanding of what that business is truly worth. It's much easier to hold on to those shares. And potentially even take advantage of lower prices and buy a little more. That's
Mm.
pretty tough to do if you don't really understand what you own.
Yeah, I can kind of sense that there's probably a lot of rules and systems and structure around the way that you do this rather than emotion, right? Like, I guess watching your favorite, the thing that you've emotionally attached yourself to in terms of a company, go down, that kind of triggers a whole bunch of emotion defense mechanisms, and all sorts of biases kick in. But you don't need to worry about any of that, right? Because you're really just saying, well, I'm not even going to be in that position unless I've understood the business, which will also equip me during the times where the share price does something that I'm not expecting due to circumstances I can't control, right?
Yeah, exactly. And I mean, everyone makes mistakes, and sometimes you get stuff wrong, and it goes down for legitimate reasons that you missed. But you wanna try and minimize the chances of that.
Yeah. Okay. So let's take us to the next M, Tom. Moat. So what is a moat?
Sure. So, moat is like an old Buffett idea, basically. In order to protect your economic castle from competitors, you need to have some sort of moat, which is kind of like the competitive advantage that keeps other competitors out. So, just to keep using, Apple as an example, you know, consumers are very happy to pay a premium to buy an iPhone versus some unbranded phone that isn't in like the Apple ecosystem, because if you buy an iPhone, it has connectivity to integrations between all your different Apple devices. You can text your friends, and you got the blue messages instead of the green messages, and all that type of stuff. So
Mm.
yeah, you're looking for things that allow that business to survive and kind of thrive over the long term. And that can come in lots of different forms. For Apple, it's probably a couple of things. It'd be a very well-known brand. Also, to a certain extent, probably like what you'd call a switching moat. So basically, it's a pain in the backside to take all your data, maybe all your music or podcasts or whatever, off your iPhone and put them onto an Android phone. Maybe it's some sort of like toll bridge type moat where you have to use a particular company's product or service to do a certain task. That could be a literal toll bridge, or some other form.
Mm.
Or maybe you're like a low cost producer. So maybe you are in one of these really bumpy commodity type businesses, like you're an oil company, for example, but you can produce oil for $30 a barrel, and all your competitors can produce it for $50 a barrel. So if oil prices go down, you have a structural kind of low cost advantage and can remain profitable for longer than other companies. So those are the types of things
Yeah.
that you're kind of looking for.
I guess that kind of like it's a general principle that applies in life, irrespective of what you're doing, right? Like what
Yeah,
actually is it about you that makes you unique, right? And what can
exactly.
you do with success versus somebody else? That's what you should be doing. So it follows then that if you're investing in companies, you should be looking at it almost through the same lens. What can they do well that others will struggle to compete on? And understand it, but it's multidimensional, right? Like it could be a literal moat. It could be
Yeah,
like tolls, like you say, or a competitive advantage due
yeah,
to geographical regions, or even just a network. Maybe the network gets out there and it's got a
yeah, for
first
sure.
mover advantage, right?
Yeah, I mean, it's like if I've just moved to Whangarei. Let's say there's no laundromats in all of Whangarei. So if I start up a laundromat and it's super profitable, that's a business that really has no moat. Like there's pretty modest kind of entry cost to get into that business. And someone else could start up a laundromat right next door, and my supernormal profits would go down pretty quickly, I'd imagine. So
Yeah.
that's the type of thing that doesn't really have a moat. And you're trying to look for the types of businesses where people can't necessarily kind of compete against you, or at
Yeah.
least not as easily. Yeah,
At least not as easily. And I think there's so much in that, right? Like I'd love to go off on tangents everywhere on that one, but that's the second M, right? So we
yep.
have meaning, moat, and then that brings us to management, the third
Hmm.
M. And so I think I've heard you say this, which was a quote from someone else, like, I guess, invest in businesses that even, I'm going to paraphrase this and make it my own, invest in businesses where even a Muppet could run it because someday a Muppet will run it. Is that right?
Basically, yeah,
Who said
yeah.
that and how did they say it properly, Tom?
I believe originally it was Peter Lynch, and
Right.
yeah, he said something
Yeah.
like invest in businesses that an idiot could run because one day an idiot will. And
Right.
I think Buffett described Coca-Cola as I believe he said even a ham sandwich could run Coca-Cola. I think that's something he might have said in the 90s. So yeah, they're the type of things you're looking for, but
Right.
not all businesses are like that. Some you do definitely need pretty talented management because they're hard businesses, or they go through cycles, or maybe they're actually phenomenal businesses and a ham sandwich could run it, but then they'd go out and make a bunch of dumb acquisitions or something and just kind of burn cash. So um,
Okay.
yeah, you're trying to look for basically two things, I think, at the end of the day in a management team. People that are talented and can generate, good returns either on internal investments that they're making in the company, or they can kind of grow the business in an efficient manner. And if they can't do that, then they make the rational decision to pay out a dividend or do a share repurchase rather than just trying to grow the pie for the sake of growing the pie and earning poor returns on capital and stuff. So you're looking for that sort of talent, and I think you're just looking for like integrity, and aligned incentives are always really nice to see. If you can invest in a company where 10 or 15% of the shares outstanding are owned by the family or the guy running the business, and their annual salary, their compensation from that is kind of like a rounding error relative to what they'll get from the share price performance over time. That's always nice to see as well.
So you kind of just have to put your head inside the head of the business owner, because you are when you're a shareholder anyway. And it's your baby. You want to make sure it's taken care of. Who's looking after my kid? How are they qualified? What have they done in the past? How complex is this machine? How are they being remunerated? Do they possess any ideologies which could be harmful to the business and the environment that we're heading into? Like
Exactly.
there's
Yeah.
probably no limit to what you could put in the subset of the criteria there, right?
Yeah, it's one of the tougher ones. It's more qualitative than quantitative. Like you're working with people, and smart people do dumb stuff sometimes. So it's not the easiest one to figure out, but there are some general kind of things you could look at. Like there's a pretty famous Charlie Munger idea of show me the incentive and I'll show you the result. So, or I'll show you the outcome. The more you can get those aligned incentives, the better. Like a terrible one that I kind of hate to see is managers being incentivized purely on revenue growth, for example. That type of stuff encourages selling things with very low margins, for example, or making overpriced acquisitions. Whereas if you incentivize a management team on return on invested capital or return on equity, for example, that can be much more aligned with what would benefit a shareholder over the long term.
Sure, that's right, because the shareholder is looking at a time frame which might very much exceed the tenure of the management team, right? Like you might be 20, 30-year-old plus investor in terms of time frame, 20, 30-year-olds to invest. But from the point of view of some of the people that are working in the management team, they might just be using that as a stepping stone in their career so they might not have incentives aligned with yours as an investor, right? Is that what you mean by that?
Yeah, for sure. They can make short-term decisions that are really profitable for them, which aren't great for long-term owners potentially. If they're
Yeah,
incentivized to grow revenue, I don't know, 50% in the next 5 years, they can maybe do that with a couple of acquisitions. But if
yeah,
those acquisitions only, earn, I'm just putting numbers out here now, but if they earn, say, 2% cash flow yields or, something really anemic, that's going to allow the CEO to meet their incentive targets and maybe get a big bonus, but it's not going to be that attractive for
sure,
long-term owners. You're probably better off just paying that cash out as a dividend at that point if you can't earn, nicer
sure.
returns internally. Yeah.
Okay. No, that's cool. And so take us, we kind of already touched on this one, but the fourth M in this checklist is the margin of safety. So at what stage do you kind of pull out the old margin of safety? Is that when you kind of have done the other M's and you're now at the final stages of going, right, well, it's got ticks in every area. This is now the
Yeah.
part where you create a rule, like an if then rule, right? If the share price hits a certain point, then you will buy it. Is that right?
Yeah, basically, I would like to say that I leave this step till last, but oftentimes I don't. Oftentimes I might just get interested in the company in the first place because the valuation looks interesting just on a kind of surface level check. But I've then got
Yeah.
to kind of start from the beginning and actually make sure I do understand the business and I can tell whether it actually looks reasonably priced or not. So there's a
Yeah.
few ways to go about margin of safety and calculating a valuation. Like I mentioned earlier, it could be asset based or it could be cash flow based. You
Okay.
could be even just comparing the price in the market of that particular company to other companies in the industry. So if
Sure.
the average company in the industry trades at 15 times earnings and this one trades at 10 times earnings, is there a legitimate reason for that, or what's kind of going on there?
Mm.
um, that's the type of stuff you're trying to figure out. But I've also got checklist items in there, like to make sure that the absolute valuation still looks interesting and not just the relative valuation. So, last year, or in the past couple of years, we've had all these like high flying, super fast growing software as a service businesses, right? And when you look at those companies, all of a sudden people start talking about, rather than a price to earnings, ratio, they start talking about price to sales ratios. And
Right. Gotcha.
that's, yeah, if something trades at 10 times sales and all the competitors trade at 15 times sales, yeah, I don't know if that's actually cheap. Like if you imagine, how much revenue you generate in your business, for example, Darcy, and then you slapped a 10 or 15x multiple on revenue as like a value for the business, you can get to some pretty large numbers. So
Yeah.
um,
Yeah.
yeah, it does have to be sort of cheap in absolute terms, I guess.
So we go through the 4M checklist, and we pretty much right at the very end of it or somewhere in the process, we have a price. And then like how often are you actually buying and selling stocks? Because I'm guessing with the mindset of a true value investor, it's predominantly front loaded with a lot of research and time and patience. And there's a very, very small portion of it, which is actual investment implementation. Is that right?
Yeah, it probably actually would surprise a lot of people to hear about how infrequently I have transactions. But my goal each year basically is to find maybe one or two new investments, and that's pretty much it. So
Right.
I try to be a pretty harsh grader, I guess, when I'm
Yeah.
looking at companies and management teams and that sort of stuff.
Yeah.
Once I'm in a company and I feel like I understand it, even more as I continue to be like a long-term owner, like that, I haven't been investing that long in the grand scheme, but I've already got, a couple of stocks in there that I've owned for 4 years or so at this point. So, I've seen a few years of more financial results and how the business is performing. And if the price goes down, I'll be willing to add to those positions if I think it's still interesting, or I might even pay higher prices than I did in the past because I think the value of the business has gone up.
Right.
But in terms of finding new investments, kind of depends what's going on. Like if we have a massive market downturn, there might be more stuff out there that's available, at really attractive prices. But usually I'm trying to find one or two things a year over a career that turns into quite a lot of companies. So I'm
Yeah.
not trying to get 30 stocks out, right out the gate or anything.
I guess the same sort of methodology that you use to select and to buy in at a certain price. Do you have almost like the inverse of that in some way, which is when to get out, or is it only useful for getting in?
Um, yeah, I think the selling decision's a lot harder than the buying one, to be honest. The buying decision is usually because you think it's a good business at a reasonable price, or maybe an average business at a really, really good price. I'm not opposed to buying them either. But selling's more tricky. You might have a really good quality business. Maybe it gets a little expensive, and then you kind of have to make the call about, if I were to sell this, where would the cash go? Would it just sit in a savings account doing not much, or do I actually have somewhere interesting to invest that? Have I found a new company? And there's a funny saying I like from a guy called Monish Prabrai, who's an investor I follow, that on first impressions, the mistress always looks hotter than the wife, but in fact, the wife is always hotter. And that's basically to say that just because you think you've found some new company that looks kind of interesting doesn't mean you should immediately flip the switch. You bought the original business for pretty good reasons in the first place, hopefully. So
Yeah,
I
that's
tend
right.
to try and hold on to those things if I can, but
Stick to the first love. Yeah.
pretty
But
much, yeah.
at some stage though, you've like, let's say for example, you find a company, you scale into it at what you believe is the right price, you hang on to it, it either meets or exceeds your expectations of some sort. Like how do you actually measure at what point you've achieved enough profit or enough return for that particular investment?
Sure. So I guess the first thing, being a little more negative on the whole idea, is if I've just flat out made a mistake and my assessment of the business is wrong and the business results haven't materialized and that sort of thing, that you kind of just cut your losses basically and get out. So that would be one reason to sell.
Yeah.
When things are going well, I would kind of break it into two baskets. So if it's more of like an asset-based approach, like the real estate example I talked about earlier, when the gap basically closes to very little, if I was buying at what I viewed as 50 cents on the dollar and it gets to 90 or 100 cents on the dollar, and hopefully the value of the dollar has kind of grown a little bit, that's kind of a time that I would just immediately get out. It's quite quantitative. If it's a better quality, like growing business, like a Microsoft or an Apple or McDonald's or whatever, they're the more challenging ones. I think the price would have to get pretty egregious to where it's obvious to me that the money's more useful elsewhere. Basically, it's a challenging one to put exact numbers on. Yeah.
So I guess when you're in the micro, when your analysis is all centered on a particular company and you've got in and you're thinking about that, you have some objectives around what you'd like to see with that particular move, but then also zooming out into your life around the goals that you have with your investments and how much is enough for what you want to achieve in life. You also have some broader objectives when you zoom out, right? So do you often find that sometimes those two things are in conflict? For example, like if you were investing specifically with a view to buy a home at some stage or to buy a boat at some stage or have kids or whatever the story is, do you sometimes kind of find that your views around the individual shares, around when you're going to buy and when you're going to sell, does that influence your decisions?
So far, not really. That's probably just due to the way that I've kind of structured things. Like I don't typically invest money in shares that I think I'm going to need in the next at least kind of 5 years. So
Mhm.
following that rule quite strictly has actually helped to avoid some of those conflicts, I guess.
Mm.
Yeah, I wouldn't want to put myself in a situation where I'm investing, house deposit money that I might need at any time in some volatile stock or something. So I've avoided that at all possible costs. Yeah.
Good man. Like I operate a lot in the space where managed funds, KiwiSaver, like that's kind of like the go-to for a lot of everyday investors, especially
Yeah.
those who don't have the skills yet, the desire, the time. You pick the excuse for whatever reason, and I would be in this category as well. For whatever reason, they choose that over really focusing hardcore on individual stocks. But one of the key assumptions that almost allows people to do that, we always have to revisit what those assumptions are, and that is the efficient market hypothesis, where the share price or the units in your managed fund is accurately collecting and factoring in all known information to determine what the price of that thing is that you're investing in. When it comes to a value investing methodology, am I correct in assuming that value investors do not believe in the efficient market hypothesis?
Yeah, that's an interesting one. So yeah, the efficient market hypothesis, if followed very strictly, would tell you that someone like Warren Buffett or Charlie Munger or Monish Pabrai or whoever you pick that has this great track record of outperformance is just very lucky, and they're like a monkey flipping coins basically, and they've flipped. If you have enough monkeys flipping coins, eventually one of them will flip 50 heads in a row. Um,
Yeah.
and Warren Buffett actually did this famous speech. I think it was called The Super Investors of Graham and Doddsville, which Graham is a reference to Ben Graham, and his partner, I forget his first name actually, but Graham and Dodd, they wrote Security Analysis. That's kind of one of the big Bibles of value investing, basically. Anyway, so Warren Buffett went to Columbia Business School and gave this speech and said, um, would it still be just monkeys flipping coins if all the monkeys that flipped 50 heads in a row came from the same zoo? Or in other words, they all came from this Graham and Dodd kind of school of thought. So
Mm.
I think generally speaking, markets, particularly in larger companies, tend to price companies mostly correctly most of the time. I mean, you have to keep in mind that markets are a discounting machine and they're trying to predict the future, which is inherently unknown. So there will be, times when markets make mistakes in their pricing. So I think mostly right most of the time. But I think that's quite a big difference between always right all of the time. So from time to time, you still can find inefficiencies, particularly in smaller, less followed companies. Where there's like one analyst or no analysts following the company. That's much more likely to be mispriced than an Apple or a Microsoft, where you got 50 analysts following every minute detail of the company. So the answer basically is I sort of agree that markets are probably generally efficient, but not perfectly efficient. I mean, there's very basic examples you can look at to see that markets are most definitely not efficient. Like there's a company called, I believe it's called Ford Industries, FORWARD Industries. And the ticker symbol for that company is FORD, as in Ford, like the Ford Motor Company. But the Ford Motor Company's ticker symbol is just F. And occasionally you'll see the Ford Motor Company publish really good information, and then the Ford Industries stock price shoots up because people are buying the incorrect stock. Like that's just a basic example of markets not being efficient all the time. Humans make mistakes. So there's definitely occasional things that can pop up, and oftentimes people running mutual funds and so on, they have people benchmarking their performance quarterly and perhaps even monthly in some cases, and they want to um, get somewhat consistent returns. I mean, anytime you're working with stock markets, you're not going to be trucking upwards every month or quarter unless you're like Bernie Madoff or something. But the point is there's sort of some short-term incentives there where in most cases you're probably best set up to be like a long-term owner of good businesses. So if you are a mutual fund manager, you're probably unlikely to own like a real estate company at the moment, for example, or some other company that looks like it's maybe going to go into a down cycle over the next couple of years. But if you are a longer term owner of those businesses and you think the long term prospects are good, you can potentially scoop up shares at really interesting prices. So I think there's a few of those like structural things in markets that can create opportunities as well.
Okay. So on that structural piece, one of the things that I chew on every now and then is just this question of whether or not in mainstream circles, especially with those who are really into index investing, passive investing, dollar cost averaging, diversification, that sort of space of investing, which is a very different silo now to what you operate in. But I wonder if there's almost like this systemic bias in the investment community that encourages people to invest no matter what the environment, because that has been the best answer over time, but that doesn't necessarily mean it's always the best answer in the future. Do you have any thoughts around that?
Yeah, I think for people that don't care for looking at individual businesses or don't feel that they can do it or whatever, I think it's a really good way to go. Like I say, it's worked quite well over time. If you can just capture market returns and pay really low fees, you'll do pretty well if you can invest consistently over time. The main challenge there is going to be psychological more than anything. It's one thing to say theoretically, I'm just going to keep buying, regardless of whether markets are going up or down, but you've got to probably set it up in a way that's kind of robotic and where you don't have to actually do anything just to make sure you keep kind of trucking along. I think, yeah, over time it'll probably work.
Yeah. Yeah. And I think like what the last 6 months have shown me in particular is that regardless of what we think we know and what we believe we follow in terms of rules, we don't really follow it. When we feel scared, we don't do anything. And there's a lot of people probably sitting on their hands right now. But if you follow a disciplined strategy like what you do with the value investing methodology, it really is just doing the work, and you don't really worry about the market at all, do you? You're just waiting for those opportunities to come to you, right?
Yeah, like having checklists and things in place can really help you to remain rational, I suppose.
Yeah.
I've like in March 2020, for example, I've always been pretty good at not like panicking and selling stuff, but I can definitely get better at taking advantage and buying more, I think. And a couple of years back, I would have talked about that quite theoretically and maybe bought a little bit of stuff, but having
Mm.
some more structured kind of plans in place, I think is going to be useful.
Right.
Has been a little bit already. This year where we've had some stuff get beaten up. So,
Yeah.
yeah,
And so
anything you can do to remain rational is a good thing.
yeah, rational and liquid, right? Like to have a system, a rational system, but also have the capability and the firepower to execute on those decisions is important. So
Mhm.
like at the moment, are you kind of looking at the next, say, 12 months thinking volatility? Great. There could be opportunities here. And are you ready?
Yeah. I mean, I try not to get too caught up in like predicting markets or anything like that because I don't think anyone could do it, even if they tell you they can.
Yeah.
So if there is volatility over the next 12 months or however long, then that's great. Um, I'm just kind of looking at the opportunity set as it's happening in real time and trying to make the best decision I can.
Right.
So yeah, that's how I'm
Right.
sort of working through it.
When the trees go a shaking, the low fruit go a falling into your lap, hopefully, right? And that's how it's done. Cool.
There you go. I'm going to borrow that.
Yeah, you should, man. I just came up with that. There you go. So Benjamin Graham, The Intelligent Investor, 1949, I believe, is when that came out. Really good book to read for those that are interested in this. Any other resources apart from your amazing YouTube channel, Investing with Tom? What other resources can we throw out there to our audience, Tom?
Yeah, sure. I guess if people are interested in reading, the Phil Town books are genuinely a really good place to start. They're probably a little simplistic in places, and you graduate a little bit from certain aspects of
Yeah.
Phil Town, but he's a great one to get you started.
Mm.
He's probably the first person that put some of these complex, well, they're not that complex really, but put some of these Buffett ideas into like practical, actionable steps. So
Yeah.
if you're a reader, I'd probably start with Phil Town and then maybe go Intelligent Investor. I did that the other way around, and the Intelligent Investor is pretty dry. So maybe do
Right.
Phil Town first. I would say pretty much just consume anything you can that Warren Buffett and Charlie Munger have ever said or written. So there's years and
Yeah.
years of Berkshire Hathaway, annual letters you can read through, or
Yeah.
um, I think there's about 20 years or so of annual meetings on YouTube you can kind of watch through as well if you're interested. Those are all great places to start.
Or you could just buy Bitcoin, right, Tom?
I don't know, man. I know you ask me this every time I'm on, Darcy, but no, I don't have a strong view on Bitcoin.
Yeah. Good answer.
Yeah,
Good answer.
I don't. I'm not going to be able to add much on that. I hope it
That's right.
works well, but
I hope
I
it
don't know.
works well for you, man. I hope it works well. Good way of leaving it. No, that's awesome. So yeah, again, investing with Tom. What other? Because you have a podcast as well, and there's more than one YouTube thing that you do. So where can people find you, Tom?
Sure. So, yeah, the main place for content is just investing with Tom on YouTube. I also have the Investing with Tom podcast, which there's a video version on YouTube and available on all good podcast platforms if you just look that one up. And then I'm pretty active on Twitter at Tom Investing, and also have a weekly live stream channel with four other kind of value investing YouTubers called Punch Card Investing. So New Zealand time, we're usually live about 3:30 on a Saturday afternoon if you want to come along and throw questions at us live.
That's awesome. Awesome. Well, get amongst it. Like there's amazing resource out there for anyone who's listening and watching. So, Tom, thanks very much for joining me on the show today, and all the best with next year and all the opportunities, no doubt, that will come your way.
Yeah, thanks for the invite.
Cool. Cheers.